Good morning. We're Westminster College CFA Team B. Our team members are Lee, Frederic, Zach, Denise, and Colton. And today we'll present our findings from our team's analysis of R1 RCM. We recommend a sell rating with a price target of $9.04, forecasting a 34.06% negative return. Our sell rating is derived from several factors, including the credit risk, which halts their growth strategy, top customers exhibiting poor financials, customer dissatisfaction, mainly the onboarding of pediatrics, and recent C-suite sell-offs and departures.
Revenue cycle management process the financial and administrative component of healthcare from appointment to payment collection. As an RCM vendor, R1's legacy end-to-end RCM outsourcing solution managed the entire RCM process in place of healthcare organizations' in-house team. Since acquiring CloudMed, R1 has greatly expanded its modular service and now generates 1/3 of its revenue. R1 has experienced rapid revenue growth over the years, but especially in the past 2 years, we're observing a lack of organic growth in their legacy solution, and their growth has been driven by acquisitions, which led to high leverage and there is therefore unsustainable. Along with the rising interest rate, R1 will have to put a pause on their buying spree. U.S. RCM outsourcing market is valued at $140 billion and expected to grow at 10.3% annually until 2030. We might want to redo that.
I know, I got a phone call and it kicked me off my thing. Sorry. It pulled me off and I couldn't switch slides.
Okay.
All right.
Want to redo it?
We can just cut it out though. Yeah.
Sorry, let's redo it.
You want to just cut to your stuff, Lee, or just start? Let's just start at the beginning. It's easy enough.
Yeah, let's just start. Sorry, Denise. I know it's in lane.
Switch.
Yeah.
All right, you guys ready? Okay, good morning. We're Westminster CFA Team B. Our team members are Lee, Frederic, Zach, Denise, and Colton. And today we'll present our analysis and findings of R1 RCM. We recommend a sell rating with a price target of $9.04, forecasting a 34.06% negative return. The sell rating is derived from several factors, including credit risk, which halts growth strategy due to a large amount of floating debt, top customers exhibiting poor financials, which directly impacts R1's performance, customer dissatisfaction, mainly the onboarding of pediatrics, and recent C-suite sell-offs and departures.
Revenue cycle management process financial and administrative component of healthcare from appointment to payment collection. As an RCM vendor, R1's end-to-end legacy RCM outsourcing solution managed the entire RCM process in place of healthcare organizations' in-house team. Since acquiring CloudMed, R1 has greatly expanded its modular service and now generates 1/3 of its revenue. R1 has experienced rapid revenue growth over the years, but especially in the past 2 years, we are observing a lack of organic growth in their legacy solution, and their growth has instead been driven by acquisitions, which led to high leverage and is therefore unsustainable. Along with the rising interest rate, R1 will have to put a pause on their buying spree. U.S. RCM outsourcing market is valued at $140 billion and expected to grow at 10.3% annually until 2030. We predict a lower growth rate for R1, however, compared to industry forecast, as the technical complexity and specialized knowledge and large skilled workforce required in the end-to-end RCM outsourcing service poses a barrier for rapid expansion. as does the limited automation capabilities and delaying integration of their new modular system from CloudMed.
When analyzing the financials of RCM, we first have to define how they actually make money. RCM has three main revenue streams: net operating fees, which are connected to the RCM products, incentive fees, which are performance-based fees, and other. Why was there no profit in 2022? As we can see, incentive fees declined by 50%. The reason are longer processing times for reimbursement. The main problem was pediatrics, which had integration problems of the RCM products. However, pediatrics is not an isolated case, which suggests that RCM will have significant operational problems in the future. Additionally, it is also really off-putting for future potential customers for RCM. Our major concern is the customer concentration of RCM. As we can see, 52% come from one customer, which is Ascension. Ascension is unfortunately facing financial difficulties. The operating margin declined to negative 3.1% in the recent year. The reason are a 9.1% increase in wages and increase in cost of goods sold. However, to secure operations, they will need to take out further loans, which will result in high interest payments.
As Lee already explained, a huge part of R1's revenue growth is coming from acquisitions, which in turn also means that R1's organic revenue growth is pretty low. Compared to its competitors, R1 has one of the lowest organic growth rates. Compared to its competitors, R1 also has one of the lowest net margins because of higher interest expenses and the fact that one of their physician customers was not able to pay its bills in the last quarter. R1 also has one of the highest debt to EBITDA ratios, which significantly increases the credit risk. The debt to EBITDA ratio is so high because of the last acquisition of CloudMed in the second quarter of 2022, which almost doubled the amount of total debt. After the acquisition, the debt to EBITDA ratio reached a value which is higher than 5, which significantly increases the risk of getting downgraded by one of the rating agencies. Currently, we do not expect that R1 is going to increase the amount of total debt in the next quarters, but they still have to increase their profits because otherwise they will get into serious financial trouble. Taking out further loans was also subject to further financial conditions, which will make it more difficult for R1 in the future to acquire new companies. As you know, the acquisition of new companies was one of the most important pillars in R1's growth strategy in the past. Because of that, we expect that this will also have a negative impact on R1's future revenue growth rate. The timing of the CloudMed acquisition was also not very favorable because just right after they acquired CloudMed, interest rates skyrocketed. We think that R1 has to use almost 50% of its EBIT in the next quarters for interest payments and for principal payments. For the valuation part, we decided to use 4 different valuation methods, and we calculated a price target for each valuation method. We also assigned a specific weight to each valuation method, and out of these 4 price targets and 4 specific weights, we calculated a weighted average, which is our final price target. We assigned a weight of 40% to our DCF valuation because our DCF model is our most sophisticated and most accurate model. We assigned 30% to our EV/EBITDA valuation because EV/EBITDA valuation eliminates the impact of capital structure, and this is really important in that case because there are some competitors which have a high amount of debt, and there are also some competitors which don't have any debt. We assigned the lowest weights to price to earnings valuation and price to free cash flow valuation because it's very hard in that case to forecast future earnings and future cash flows because of strong market movements and the high amount of acquisitions in the market. Our DCF model is supported by a Monte Carlo analysis, and both models come to the same price target of $8.95 per share. For both models, we used an explicit period of 8 years with a growth rate of 8.24%, which means that we use a 20% lower growth rate than the projected industry growth rate of 10.3%. We use the lower growth rate because we think that there's a high risk in investing in R1, and these risks will also have a negative impact on R1's future revenue growth rate. For the EV/EBITDA valuation, we use a forward multiple of 11.72, and we use the price premium of minus 10%, which is calculated by 4-year historical averages. This results in a price target for the EV/EBITDA valuation of $6.18 per share. For the price to earnings and the price to free cash flow valuation, we also use forward multiples and we also use price premiums, which are again calculated by 4-year historical averages. This results in a price target for the price to earnings valuation of $11.98 per share and for the price to free cash flow valuation of $12.09 per share. So out of these 4 price targets, we calculated our final price target, which is $9.04 per share. This means that we project a future negative return of 34.06%, assuming a current price of $13.71 per share.
In terms of ESG, R1 has undergone significant changes in its wholesale management, indicating potential financial struggles for the company. The new executives will face difficulties in balancing priorities, managing operational disruptions, and gaining the trust of employees, stakeholders, and customers. In R1's case, acquisitions provide the illusion of improvement without addressing the underlying issues. Without proper execution, the recent acquisition may result in integration problems and cultural conflicts. In the last 18 months, executives have made sales equal to 27% of their holdings, a large portion of their total holdings. This suggests that executives have concerns about the company's future performance. As the CEO has the most insight into the company and has made the most stock sales among executives, this could indicate deeper problems within the company. Lack of internal controls leads to low employee satisfaction, as indicated by R1's low ratings on Glassdoor and Indeed compared to competitors. This is due to inadequate communication between management and employees, accountability issues, low compensation, and excessive micromanagement. Sourcing work in India and the Philippines raises additional concerns about quality, software security, and job security. Poor social and environmental ratings increase the risk of negative publicity and harm to the company's reputation. This poses long-term sustainability risks, including high employee turnover, limited career advancement opportunities, and a lack of diversity. R1 also currently faces active lawsuits for securities law violation, as well as a recent ransomware attack and name change due to bad business practices.
In summary, we assign R1 a sell rating with a price target of $9.04 with a current price of $13.71. We believe they need to catch up with future trends. They have limited future revenue growth, customer integration problems mainly with pediatrics, strong customer concentration, high credit risk, and management pessimism. Thanks.